Topic A tonight. Fed Chairman Ben Bernanke admitted today that we are stuck with stagflation, slower growth, faster prices. Trouble is, he doesn't seem to have a real plan to deal with it. Perhaps that's why stocks dropped 80 points after hearing the news conference. Look, QE2 ends, but the future is murkier. Maybe there's QE3. Maybe there's even a tightening of the Fed's balance sheet. Yes, the zero Fed funds target remains in place for an extended period. But Mr. Bernanke thinks first half stagflation of only 2% growth and 5% inflation will dissolve into an Alice in Wonderland, 3.5% growth and only 1.5% inflation in the second half. Color me skeptical. Does the Fed head really have a plan to rescue the economy? We've assembled an all-star panel to cover this story like no one else. We have Congressman Ron Paul. He's Republican from Texas, who now chairs the House Financial Services Subcommittee that oversees the Fed. CNBC's ace reporters Steve Leisman and Rick Santelli. Former Federal Reserve Governor Wayne Angel and Mort Zuckerman, Chairman and Editor-in-Chief of the U.S. News and World Report. Gentlemen, thank you very much. Good evening to all of you. Mr. Paul, I want to begin with you on the campaign trail and almost everywhere. You're a Fed critic. You've actually called for the elimination of the Fed. You want to audit them with your oversight. Let me ask you what you took away from the Bernanke press conference today. Is it right direction or wrong direction in your view?
Well, it's the wrong direction because it's no direction. It's the same old stuff. You don't know exactly what he's going to do, except I am convinced that he will continue to expand his balance sheet. He's going to continue to buy, whether it's QE2 or QE3 or whatever. He's not going to allow interest rates to go up right now. So I would say that's the wrong direction. He can't solve the problems of keeping interest rates too low too long by doing interest rates lower for a lot longer. So it makes no sense at all.
All right, Steve Leisman, was there any sense to it today? You know, I heard you interviewing earlier today, and you got some people that think there might be QE3. Other people think there might be a tightening of the balance sheet, Steve. I think everybody's confused. I think the stock market was confused. What do you say?
I think confusion might be a good word right now, Larry, but I think that's probably because it's not entirely clear to the Federal Reserve what the next step is going to be. And I think the reason is because the Fed is really resting its hopes on the second half recovery, on the idea that a lot of the factors that are affecting the economy right now are indeed transitory, those supply disruptions, the spike in the price of oil, and that those go away, and that leads to a better second half. There was some give by the Fed chairman that maybe some of these things last a little bit longer, which is why the 2012 forecast also came down, both 2011 and 2012 coming down by half a point. I see the Fed, Larry, as sitting in limbo. The idea that it's neither in any hurry to exit its easy monetary policy, but really not giving up too much in the way of any additional quantitative easing coming down the spike.
Well, Mort Zuckerman, do you think the Fed has a plan? And do you think it's Alice in Wonderland to say after the economy has sputtered, the inflation rate has jumped in the first half, we're suddenly going to have 3.5% strong growth in the second half and only 1.5% inflation? Mort, I ask you, is that reasonable? Is that logical?
Well, look, the fact is that the reason why the inflation rate is up, of course, this reflects things that are beyond the Fed's control. It's primarily energy prices, food prices, and clothing prices. So I don't think that's something that you should hold against the Fed policy in terms of its effectiveness. I do think that it is critical, and I mean critical, that we do something to help this economy get out of the funk it's in, and it is really in a declining state right now. And if you raise interest rates or allow interest rates to go up, you'll affect a lot of small businesses. You'll affect a lot of variable rate mortgages in the housing market. I think it would be absolutely the wrong time to do it. So I completely support the continued easing by the Fed of the monetary system and the monetary supply. We must keep some stimulus going in this economy because we're going nowhere at this stage of the game except down.
Rick Santelli, beyond the Fed's control, $600 billion of pump priming, a falling dollar. I mean, interesting, Mr. Bernanke did say the economic slump is caused by higher gasoline and energy and food prices. Is that all beyond the Fed's control, Rick?
Well, listen, all the movement in energy or all the movement in commodities isn't due solely to some of the policies of the Fed. But without a doubt, a portion of it is. And I don't think Mr. Bernanke has really fessed up to that. Mort just pointed out that, he thinks that commodity prices are beyond his control. I think that they could have absorbed a whole lot more of their fundamental move if it wasn't for the fact that the dollar was collateral damage. And also keep in mind, we just assume now they're not going to move rates. We almost don't even talk about it. Keeping rates too low too long is not a victimless crime. Think about these senior citizens out there.
Can I add one comment here? The cheaper dollar, I might say, may have had some effect on oil prices, but it's also had a stimulative effect on our exports, which is one of the few growing parts of the economy. And whatever it is, it's been a big of it. Has not gone down, it's gone up. It's one of the few things we can say about what's powering this economy, such as it is.
Wayne Angel, let me get you in as a former Federal Reserve governor. Is the Fed powerless over this inflation? Do you believe they can pull a rabbit out of the hat and get inflation down in the next 6 months in order to get growth up, Wayne?
Well, they can pull a rabbit out of the hat if they'll try to pull a rabbit out. And inflation is always a monetary phenomena, and to blame higher oil prices and commodity prices on inflation going up is nonsense. What the Fed fails to do, the Fed fails to understand, is we're in a regulatory slowdown that is tightening down mortgage loans through the GSEs and through the FDIC. We've shut down the lending of our commercial banks, and that's why the economy is so slow.
But Congressman Paul, Mr. Bernanke came out today against spending cuts. He said immediate spending cuts would damage the economy. Now, as far as I get it, Washington is puzzling over how to get some immediate spending cuts. What's your take on that? Is Bernanke right or wrong on the budget?
Well, he's wrong on it, because you want spending to occur, but you don't want the government doing the spending, and you don't want the government to regulate interest rates. You don't want central economic planning through monetary policy. So if we weren't spending so much money through the appropriation process, either inflating the currency for that purposes or increasing taxes, then the people would have the money. So you want to encourage people to make money, but they have to spend it. Politicians and bureaucrats and bankers and central bankers have no idea where the money should be spent. So yes, we should increase spending, but the people should make all the decision. That means a lot of cut in spending from the government and big cuts in taxes, and change a lot of other policy in order to sustain ourselves and get growth back again. And there's a lot of things that we could do with our tax policy as well as monetary policy.
I mean, Steve Leisman, I go to you. Are you surprised to hear Mr. Bernanke say don't cut spending immediately? That seems to run against all the instincts. You heard Congressman Paul. Frankly, even Democrats would disagree with Bernanke, Steve. What is that all about, and what does it have to do with his Fed policy?
Not surprised. I can tell you that I leaned over to a colleague of mine when he said that, and I wrote, he's going to pay for that, because especially when he said that cutting the deficit now won't create jobs. I can tell you, Larry, that is the general thinking on the part of most economists right now, that immediate spending cuts will not create jobs. Long-term getting the deficit in order is good for the job market. But the idea right now that somehow the government is crowding out private investment is simply, I don't see it in the books. And Larry, let me push back on you just a little bit on the idea that the Fed doesn't have a plan. On the one hand, they do have a plan. They're going to maintain a $2.6 trillion balance sheet. And the second thing, if you don't know what exactly the problem is, why would you have a plan to fix it? Why wouldn't you wait for clarity before saying, you know what, here's my plan?
Well, if you don't know what the problem is, aren't you in trouble here? All right, go ahead, Mort Zuckerman.
We're in a situation where you have, in real terms, declining consumer expenditures. The consumer sentiment is as low as it's been. The average, according to the Conference Board, during recessions is 73. It's down to 60. We have housing prices that are continuing to go down. We have unemployment that, in fact, is continuing to go up. And really now it's somewhere around 18%, not 9%. We cannot be in a situation where we introduce deflationary policies into our economy. Yes?
Mort Zuckerman, wait a second.
I look at it, Larry,
Mort Zuckerman, you are the biggest budget hawk in the history of the earth. Are you going to tell me now, are you going to back away from all the years you've said we should cut spending and the deficit? I can't. You're taking Bernanke's side. It is incredible for me. My ears must be deceiving me.
What I have said, and what I will say again, thank you very much for your low-key introduction, though, Larry. What I have said, and what I think is absolutely what we need to, frankly, increase some spending in the short run. We have to do a major job on the long-term spending programs, the entitlements, whatever. I've been advocating that for years, and I agree. But we are in an unprecedented kind of economic decline. It hasn't stopped, and we cannot afford to take the risk that cutting spending and raising interest rates is going to help us.
What's happened here is that a series of temporary economic shocks have been put into the political stew pot and been trumped up into a huge political issue beyond any objective analysis. Does anybody deny that the automobile industry has down for the count because of the supply disruptions?
Go ahead, Rick.
Anybody deny
these
that?
supply disruptions, they're going to whip it up to be the excuse for everything that's going wrong.
It's all political. That's the newest and latest thing.
Let's take spending, for example. How absurd is anybody, including the chairman, when he says if you slow down some of this spending, that jobs are going to be lost initially? Well, of course they will be. Initially,
hey, Rick,
of course they are. If you eat nothing but Milky Ways and you drink nothing but coffee, you might get some energy. Wait a minute. But if you want a good diet to get energy, that's the way to go. If we want to get the economy going, quit the useless spending, and the jobs that have no sustainability might disappear to have a good footing to build on something solid. That's what we need. Control spending and go for growth.
Here are the facts, Rick.
But hang on a second, Mr. Paul, Congressman Paul, what I heard you say earlier, please clarify, you think we should have spending cuts, we should also have lower tax rates and deregulation. Is that a growth plan? Did Mr. Bernanke miss an opportunity to really tout a growth plan, Congressman?
Well, if he represented the free market, that's what he would have advocated, and there are a lot of places where we can cut, whether it's overseas spending, Department of Education, Department of Energy. There's a lot of places we can cut without even going after child health care. But that's what you have to do. You have to cut, and you've got to lower the rates. I would like to see a removal of the taxation on repatriated funds. If I don't want the Fed to create the new money, where's the capital going to come from? It should come from savings, and our corporations have money overseas. We need to invite that capital back. We don't need to chase it to China. And countries that deliberately have weak currencies have more difficulty attracting capital. And it was suggested there that a weak currency helps stimulate the economy. Yeah, for a week or two, but a weak currency is never advantageous. Read today where there was advice that, boy, if we could just get up to 5% inflation rate, we can start liquidating debt.
Well, we're there. We're there. We're at 5% already, and who knows what the future holds.
Bernanke actually wants to do that. He knows that liquidation of debt is not going to come by our not sending the checks. It's going to come through devaluation of currency, which is an immoral and it's illegal and is unconstitutional act, and it's really bad economics.
Wayne Angel, I want to give you the last word. As the former Federal Reserve Governor, and Lord knows you should have been Federal Reserve Chairman, if you could wave a magic wand, Wayne, briefly, what would you have Mr. Bernanke do right now when he goes to work, let's say, tomorrow morning?
I would have Mr. Bernanke ease off on the banking system. Let banks make loans, encourage them to make loans. This is not the time to continue to shut down mortgage lending. That's where it is. And as long as you shut down mortgage lending, the economy is going to be weak, and then you're going to try to no avail to have all that money out there. It won't work.
All right, we're going to have to leave it there, gentlemen. Very calm, low-key discussion. I appreciate it very much. Congressman Ron Paul, thank you. Steve Leisman, Rick Santelli, Wayne Angel, and the great Mort Zuckerman.